Welcome to The Explainer. Today, we are tackling one of the most powerful and, let's be honest, dangerous events on the entire economic calendar, the U.S. Non-Farm Payrolls Report. Yep, this is the big one. It's a monthly data bomb that can move global markets in a flash, and today we're going to break down a professional framework for navigating all that chaos.
People call the NFP the king of volatility for a reason. This isn't just another economic report. For a few minutes, once a month, it's like a stress test for the entire global financial system. It can literally rewrite the market story for the entire month ahead.
But here's the thing, the game has totally changed. The old way of just watching to see if the headline number beats or misses what the analysts expected, that's not just outdated, it's a recipe for disaster. So let's dive into a much smarter approach.
So first things first, we've got to understand the new battlefield. We're going to break down why the NFP's gotten so tricky and introduce the modern framework you absolutely need to handle it.
Okay, so here's the core problem. The first few seconds after the number comes out are completely dominated by high-frequency trading algorithms. They see that headline number and react instantly. But here's the catch. They're firing into a market where most of the normal buyers and sellers have pulled their orders just to be safe. This creates a vacuum, and that's what leads to these insane price swings. The whipsaws, where the price shoots up and then crashes down, stopping out traders on both sides before anyone can even figure out what's going on.
Now, you'd probably think the first rule of trading NFP is about economics, right? Well, it's not. It's actually about your tech. The source material for this framework makes a huge point about making sure your data is clean. Seeing an impossible date like February 30th might seem funny, but for an algorithm, that's a system-breaking error. It's a massive reminder that before you can even think about analyzing the market, you have to be 100% sure the information you're getting is legit. And that brings us to the solution, what we call the triple threat protocol. It's a super disciplined three-step process. It forces us to look past just the headline to really dig into the story the data is telling, and then, and this is key, to execute our plan with total discipline.
All right, let's get into the anatomy of this thing. We're going to deconstruct the three critical clues inside that report that you have to analyze.
Okay, Vector 1. This is the big one, the one everybody on TV talks about, the headline jobs number. The easiest way to think about this is as the economy speedometer. It tells us the raw speed of job growth, and it's the number that kicks off all that initial algorithmic madness.
But here's what's really important. The market doesn't just see a single number. It thinks in zones or tiers. A number over 200,000, that feels like a boom. But anything under 100,000 and those recession alarm bells start ringing loud and clear. Each one of these zones has a totally different psychological impact.
Next up, Vector 2, the unemployment rate. Think of this as the reality check for the headline number. It tells us how much slack, or kind of like spare capacity, is left in the job market. You see, a huge jobs number when unemployment is already super low tells a very different story than a huge jobs number when unemployment is high.
And this slide right here perfectly illustrates a super important nuance. A rising unemployment rate, is that good or bad? Well, it depends. If it's going up because tons of people are feeling confident and jumping back into the workforce to look for jobs, that can actually be a good thing. It helps cool off inflation. But if it's going up because people are getting laid off, well, that's a huge red flag for a recession. The why behind the number is everything.
And finally, we have Vector 3. And honestly, in today's environment, this might be the most important one of all. Average hourly earnings. This is the inflation number. It's all about wages. And wage growth is the kind of sticky inflation that central banks like the Fed really fear because it can kick off a nasty wage price spiral.
Okay, so we've got our three clues, but just having the clues isn't enough, right? You have to figure out the motive. The real key to this whole framework is using these clues to understand the market's mood, its deep down psychological state. That's the whole ballgame.
Think of this matrix as your cheat sheet. This is where we put it all together. You can see right away how different combinations of our three vectors create four totally distinct stories or narratives. For instance, you get super strong jobs and hot wages, bam, that's an inflationary overheat, and it basically forces the Fed to raise rates. But if you get decent job growth with wages cooling off, that's the perfect Goldilocks scenario everyone loves.
So this next point is absolutely crucial. The market's reaction depends entirely on what it's most afraid of at that moment. Is the big bad wolf inflation, or is it a recession?
If the market is terrified of inflation, then a great jobs report is actually bad news for stocks. But if the market is terrified of a recession, then a weak jobs report is also bad news. You have to know which fear is driving the bus.
And this is where the rubber meets the road. This table gives you the playbook. It maps out how different assets, we're talking the US dollar, stocks, gold, bond yields, are likely to react inside each of those psychological states. This is how you go from just analyzing the report to actually forming a concrete trading idea.
All right, last section. Let's talk survival. Because let's be real, a brilliant analysis is completely useless if you don't have the discipline and risk management to actually pull it off without blowing up your account.
Okay, if you only remember one thing from this whole explainer, please let it be this. The single most important, unbreakable rule is to stay out of the market for the first 5, maybe even 15 minutes. That is the kill zone. Let the algorithms have their cage fight, let the market calm down, and wait for the real story to become clear.
Now, once that initial storm passes, you've basically got 2 main plays you can run. The first is the fade, where you bet that the first crazy move was an overreaction because the details of the report are actually mixed. The second play is the breakout, where you jump on the trend because all 3 of our vectors are pointing in the same direction, confirming that the move is the real deal.
And this one is non-negotiable, seriously. The volatility around NFP means your stop losses have to be way wider than normal just to survive the noise. So, to keep your actual dollar risk the same, you have to cut your position size. The professional standard, you cut it by at least half.
And look, it's not just about size. It is a full-on defensive protocol. You need wider stops that are based on actual market structure, not just some random number. You should always use limit orders to control your entry price. And maybe most important of all, have a written plan before the number comes out. You know, if X happens, I will do Y. This takes the emotion out of it and saves you from making terrible mistakes in the heat of the moment.
So at the end of the day, that's what the triple threat framework is all about. It's about changing the NFP from a wild gamble into a strategic exercise. It's a process, a way to find the real clues hidden in the chaos, to understand the story the market is telling, and to manage your risk like a pro. The data is never going to give you certainty, but it can absolutely give you an edge. So the real question for the next NFP is, are you going to be a gambler or are you going to be an analyst?